This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 8, 2026, and this is the New York session. Now, let's get into it. The crypto market is currently sitting in a deep hole. The Fear and Greed Index has crashed to a staggering 14 out of 100, marking an extreme fear regime that places us in the bottom 5th percentile of historical cycles. With Bitcoin down nearly 2% to $62,267, and total market cap shedding 1.84%. The question on everyone's mind is whether this is a capitulation event or just the beginning of a longer consolidation. Good evening, and welcome back to ShadowQuant Crypto Edition After Hours. I'm your host. Tonight, we're dissecting the mechanics of this pullback, specifically looking at the liquidity vacuum in futures, the structural breakdown in high beta layer 1s, and the dangerous divergence between traditional market calm and crypto panic. Let's get right into the data. Let's be clear about what we're seeing in the psychology of the market. The Fear and Greed Index isn't just low, it's stuck. We are looking at a 14 over 100 reading with a 7-day trend holding steady at 12. That flat line is the scary part. Usually, you want to see some volatility in sentiment, a spike up, a dip down. But here, the 7-day trend of 12 indicates that panic isn't a transient reaction to today's news. It's a sustained capitulation phase. We are seeing speculative exhaustion across the board. Look at the high beta assets. Solana is down 4.22%, Cardano is down 4.48%, and Near Protocol has taken the hardest hit at minus 5.1%. This isn't just a profit-taking event. This is strip mine liquidation. The crowd isn't just nervous. They are actively fleeing speculative exposure. And with Bitcoin futures demand collapsing to 2024 lows, there is absolutely no leveraged capital left in the water to absorb this selling pressure. It's a liquidity vacuum.
And that brings me to the most dangerous anomaly in the entire dataset tonight. We have a massive decoupling event happening between traditional finance and crypto. Look at the VIX. It is sitting at a complacent 15.57. Meanwhile, crypto fear and greed is at a screaming 14. This is a statistical extreme. Traditional markets are sleeping, completely unaware of the structural weakness building in digital assets. This asymmetry creates a vacuum where liquidity is evaporating from speculative assets, without the offsetting bid support of leveraged capital. We are witnessing a silent liquidation phase where the absence of buyers is far more lethal than the presence of sellers. When the VIX stays flat while Bitcoin breaks key support, you don't get a gentle correction. You get a violent spike. The lack of futures open interest means any upward move will be shallow and easily reversed, while downward moves face virtually no resistance until we see true volume exhaustion.
I need to drill down into that liquidity vacuum Pulse mentioned, because on-chain data tells a very specific story about where that capital is actually going. We are seeing a clear flight to cash dynamic. Despite the total market cap dropping to 2.23 trillion, daily volume remains stubbornly elevated at 70.9 billion. That is not passive holding. That is active distribution by large holders. The contraction in open interest, combined with the fact that we are seeing a 700% spike in Iranian crypto outflows due to geopolitical tensions, suggests that a significant portion of that 70 billion volume is being siphoned into stable coins or off-exchange custody. The 2024 low in Bitcoin futures demand confirms that institutional players are deleveraging aggressively. They aren't rotating into spot accumulation. They are exiting the game entirely. So when Pulse mentions the liquidity vacuum, CIPHER is telling you exactly where the air is leaking out. It's flowing out of leveraged positions and into dry powder.
So we have a confirmed liquidity vacuum, a massive divergence between traditional finance calm and crypto panic, and a 700% spike in volatile geopolitical flows. Let's look at the headlines shaping this environment. First, Cointelegraph reports that Iranian crypto outflows have spiked 700% following U.S.-Israeli airstrikes. Second, CoinDesk notes that the U.S. Senate housing bill includes a CBDC ban. And third, Cointelegraph highlights that Bitcoin futures demand has fallen to 2024 lows. How do these three elements interact?
The headline regarding the 700% spike in Iranian outflows is injecting significant non-market noise into our volume metrics. It complicates the interpretation of that 70.9 billion daily turnover. Is that organic institutional activity, or is it capital fleeing jurisdictional risk? It suggests that a chunk of that volume is likely moving into untracked OTC desks or stablecoin reservoirs outside the main exchange pairs. As for the CBDC ban, that is a long-term structural narrative. But right now, the immediate reality is that Bitcoin futures demand is at 2024 lows. Institutions aren't buying the narrative. They're reducing their balance sheet exposure. The combination of geopolitical noise and leverage evaporation is creating a perfect storm for downside acceleration.
And let's not forget the distraction factor. PayPay, which owns 40% of Binance Japan, is seeking a $1.1 billion Nasdaq IPO. Core Scientific has turned lower after disappointing Q4 results. These are signals that institutional capital is being diverted away from crypto-native yield strategies and infrastructure plays toward traditional equity markets. You have a situation where the best-in-class crypto miners are getting repriced lower due to weak fundamentals, while the equity markets are offering new, flashy listings. This is pulling liquidity away from the crypto ecosystem at the exact moment we are seeing extreme fear. The market is pricing in survival, not innovation.
Let's shift gears and look at the technical structure of the market. We are seeing a broad sell-off, but the leaders and laggards are revealing a lot about investor sentiment. Bitcoin is holding at 62,267, down 1.99%. Ethereum is weaker at 1,739.9, down 2.8%. And then we have the outliers. Uniswap is up 1.79%, and Internet Computer is up 0.53%. Everything else, especially the high beta layer ones, is bleeding. Let's start with Bitcoin. Grid, what does the chart tell us about that 62,000 support level?
Price action is confirming a structural breakdown in the broader altcoin complex, but Bitcoin is currently acting as the lone pillar. At 62,267, Bitcoin is holding just above the immediate psychological support of 62,000. However, the nuance here is in the Ethereum/Bitcoin ratio. Ethereum's decline of 2.8% versus Bitcoin's 1.99% decline mathematically confirms the erosion of the Ethereum/Bitcoin pair. This is a classic flight to quality rotation. Capital is abandoning altcoin risk premiums entirely and moving into the relative safety of Bitcoin. And this is critical, this is not a healthy rotation. It's a defensive retreat. The failure of Solana, which is trading at 77.44 down 4.22%, and Cardano collapsing to 0.1667 down 4.48%. To stabilize suggests that any bounce in Bitcoin will face immediate sell wall resistance unless we see a reclaim of significant upside volume. Currently, the volume is supporting the downtrend, not the bounce.
Grid, you're describing the mechanics of the split. What's striking is the isolation. Uniswap is up 1.79% at 3.27, and Internet Computer is up 0.53% at 2.21. In a market where almost every other major cap is down double digits or single-digit percentages, these two are green. Is this a sign of strength, or is it just low-float noise in a broken market?
It's technical anomaly. Uniswap creating a defensive haven while the rest of the layer 1 sector bleeds 4 to 5% is highly unusual. Technically, if Uniswap can hold its 1.79% gain, it might act as a leading indicator for a potential floor. But if Uniswap breaks, the entire altcoin structure is technically invalid for the remainder of the session. Right now, though, it looks like a bubble in a sinking ship. The chart doesn't lie. The correlation coefficient between Uniswap and the broader market is fracturing, which usually means either a massive breakout or a catastrophic failure. Given the volume profile, I lean toward fragmentation.
Fragmentation is the right word. From a flow perspective, the fact that Uniswap and ICP are green while Solana, Cardano, and Near are getting crushed confirms that smart money is picking very specific, idiosyncratic pockets of value. This isn't broad-based accumulation. It's selective pruning. The 70.9 billion in volume is being directed toward protocols with specific catalysts or low float dynamics. Rather than general market optimism, the rest of the market is being cleared out.
Let's talk about Solana. It's down 4.22% to 77.44. That's a steep drop for a high beta asset. Grid, is the break below 77 confirmed, or is there a chance for a relief bounce?
Solana is testing critical momentum levels. At 77.44, it is failing to hold previous support structures. The daily candle is closing with significant downward pressure. There is no visible bid support at this level. If Solana closes below 77, the next logical technical target is the 76.34 area, which was the 24-hour low. The chart is ugly. Momentum indicators are flashing oversold, but in a downtrend, oversold just means more room to fall. Unless we see a decisive close back above 81, the path of least resistance remains down.
And remember, Grid, Solana is also carrying the baggage of the broader infrastructure weakness. We saw Core Scientific turn lower after earnings. Miners and validators are feeling the pinch of lower Bitcoin prices and higher operational costs. When the infrastructure layer starts repricing lower, it drags the network's native token down with it. The 4.22% drop isn't just technical, it's fundamental reassessment.
Cardano is also in the red, down 4.48% to 0.1667. Why is Cardano underperforming even compared to other layer ones?
Cardano is showing similar weakness to Solana, but with less volume backing the move. At 0.1667, it's approaching a zone where historical support existed months ago. The lack of volume on the decline is slightly less alarming than Solana's heavy volume, but the trend is identical. Both are being swept aside by the broader risk-off sentiment. The key is watching whether Cardano can hold 0.16. If it slips, we could see a rapid extension toward the 0.165 low.
Now let's look at the bright spots. Uniswap is up 1.79%. Is this sustainable?
Uniswap is the only major cap in the green. That makes it a flow anomaly. Typically, when one asset bucks the trend like this, it's either due to specific protocol revenue beats, governance news, or simply a short squeeze on a previously overshort position. Without a specific headline driver in our verified list, I'd suspect low float dynamics. It's not a market-wide bull signal. It's an isolated event. I would be cautious interpreting Uniswap's green candle as a harbinger of a broader altcoin rally.
I agree with CIPHER. Uniswap is an outlier, but let's step back to the aggregate. We have Bitcoin at 62,267, down 1.99%. We have a 14/100 fear gauge. We have a VIX at 15.57. The director's brief mentioned a risk-off mode. Apex synthesized this. What is the actual state of play? Here is the synthesis. We are in a classic liquidity vacuum event. Pulse highlighted the 14/100 fear, which is a bottom quartile reading. Grid pointed out the structural breakdown in high beta assets like Solana and Cardano. CIPHER confirmed that the 70.9 billion volume is driven by distribution, not accumulation, and that futures demand is at 2024 lows. SPECTER warned us about the VIX/fear divergence. The conclusion is straightforward. The market is shedding risk rapidly. The lack of futures support means there is no spring-loaded bounce waiting. The fear is concentrated in speculative assets, while Bitcoin is merely holding ground. The optimal read right now is that sellers are in control. Until we see volume contract significantly and futures open interest rebuild, the path of least resistance remains tilted downward. This is not a time to chase green candles in a sea of red.
So, to wrap up our analysis, we have extreme fear at 14/100. We have a liquidity vacuum with Bitcoin futures at 2024 lows. We have a sharp divergence between traditional market calm and crypto panic. And we have a clear rotation out of high beta alts into stable coins and cash. What are the key takeaways for our listeners? The key takeaway is patience. The 7-day trend of 12 suggests this fear is sticky. Do not assume a mean reversion is imminent just because the number is low. The liquidity is gone.
Technically, watch Bitcoin hold 62,000. If that breaks, expect a fast move to test lower monthly lows, Alts are already broken, Bitcoin is the last line of defense.
Monitor stablecoin inflows. Until we see that 70.9 billion volume transform into on-chain accumulation rather than off-exchange transfers, the market is still distributing. Wait for the dust to settle.
Excellent points. To summarize, the market is in a severe risk-off regime characterized by extreme fear and a liquidity vacuum. Key support for Bitcoin is at 62,000, but futures demand is collapsing. High-beta alts like Solana and Cardano are leading the decline. For tomorrow, keep an eye on the US Open and whether volume expands or contracts. Remember, in a liquidity vacuum, small volumes can lead to big moves. Stay vigilant. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.